gold and silver are holding this strong under record short pressure on SLD and GLD, what happens when that pressure fails? And I think it is failing.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 29th through October 6th, 2025, while supplies last. First this week, 1 ounce gold Philharmonics are just $75 over spot. Next, 90% silver US half dollars are just 69 cents over spot per ounce. And finally, the silver Australian Year of the Snake coin for 2025 is just $5.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. I'm always delighted to introduce this returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us every week, God willing, for a weekly market update. Today is Monday, September 29th, 2025. Andy, thanks for coming back on Liberty and Finance.
Dunagun, it's good to see you, brother. Thanks for having me.
We always look to you for an insider's perspective on what's going on in the bullion markets, and you bring so much more than that with your global perspective, keeping track of what's happening monetarily and economically around the world. But if we can't resist talking about the silver and gold's continued strength. They're on a tear recently. Silver seems to be going up $1 every day for the past couple weeks, and which Alistair McLeod would remind us is really evidence that the dollar is dropping and dropping against real things like gold and silver. But your view of the performance of the metals right now and the factors behind the scenes that are driving this continued strength.
Yeah, I'm looking at the futures right now. That's why I was glancing at my phone, and it's shocking. You have silver futures at $47.30. Up fairly significantly today, and gold futures up $50 to $38.58. So we're seeing a continual movement in the price of metals that is exhibiting strength that I'm really not used to. Dunagun, I mean, it's moving at a clip that just seems to be defying gravity, and now I don't expect it to be that way continually, but I think what it is showing is that we're seeing a lot of big money now start to move into the space. You can see that through the massive numbers in the ETF space, where we're seeing huge amount of volume go into the ETFs. This is institutional money, if I had to guess, waking up to the reality, talking to their clients about purchasing metals. But it goes beyond that. You know, we talked about the chief investment officer of Morgan Stanley, shifting his allocation model to 60-20-20, where it was 60% stocks, 20% bonds, 20% gold, breaking free from the 60-40 model that has been out there forever. But now it's going deeper than that. And now you see Bank of America, Michael Hartnett, who is talking about a 25-25-25-25 portfolio, where the strategy is 25% stocks, 25% bonds, 25% treasury bills. Those are the short term, and 25% gold. And he talks about how that strategy is up 16% year to date, whereas the plain vanilla 60-40 is up only 10%, yet gold is up almost 50%. Just goes to show. You got a guy named Chris Wood, I think is his name, Chris Wood, the global head of equity strategy at Jefferies. Jefferies Beige was the name of it before, or Jefferies Beige. It used to be Prudential Beige, and Jefferies bought them. Prudential is who nominated Miles Franklin to be an authorized reseller of U.S. Mint product many years ago. So, Jefferies took over for Beige and then got out of the gold business. Evidently, they didn't believe it was the path for them to take, yet now their head of equity strategy is talking about gold getting as high as $6,600 here in the near term. And so we are beginning to see a lot of people talk about this. You have Jeffrey Gundlach, I believe is his name, and he's, if I'm not mistaken, a trader for BlackRock. talking about, again, people need to add gold to their portfolio, breaking free from this 60-40 split. And I guess when you see players at this level start to talk about it, certainly we should take notice. I also found it interesting, Michael Oliver talking about meddling. Michael's a frequent visitor to your show, and he was talking about the lid coming all the way off is what the MSA is what they're predicting, his moving averages or his momentum averages, momentum indicator. And he says that over the next several months and into Q1 of next year, that his momentum indicators are seeing silver as high as $100 to $200. And he says that they expect such. He also talks about not being fooled by any sharp drop that we see. He looks back to the way the markets reacted before previous bull markets, and he says they fully expect to see a corrective jolt at some point, but it's part of the current upward progress, and so not to be fooled by it. I found that to be interesting. And he talked also about gold, which has broken through a 12-year-old gradual uptrend channel. Again, technical analysis, but basically saying that he thinks that this month is poised to produce a new high peak monthly close on annual momentum. There's only a few days left in the month. Again, these are all very, very, very bullish things for the price of gold. And I just think that people in this country have yet to recognize that gold is rising and rising against all of the G7 currencies. But it's not about gold. It's about loss of purchasing power in all of these currencies. And all of these currencies are now basket cases. So yeah, I think that, wait until China really starts to turn up the heat and starts to dump treasuries at a faster clip. I think maybe that's why we're seeing all the gold come back and the talk of tying gold to a new monetary system. Because in my mind, as much trouble as China is having, their yuan gets saved by gold. And the dollar, without gold to back it, it goes down. And maybe that's why we're seeing all of this gold come back, to have it tied to a new system. I'm not really sure, but when we see China building vaults all throughout the global south, starting with Hong Kong and then Saudi Arabia, you'll have the vaults in St. Petersburg, of course in Shanghai, in Singapore, Dubai. These will all be connected and tied to this gold vaulting system, where nations' golds are held in vaults in their own countries. And I think that'll be ultimately trusted much more than what we see in New York and in London. Jeffrey Gundlach, he is they call him, that just came to me, call him the bond king. And he is saying that it's time to move away from traditional 60-40 split. This is a guy who in essence, it's like the casino betting against their own game, speaking out against their own game. He's saying that you'll see gold at 4,000 by year end. And he talks about that your savings account is bleeding out, at least at 4% per year, but actually it's probably a lot more than that. They talk about a money supply that has increased by as much as 7% per year. You see M2 again racing higher right now. So as we see money creation running at such a level, your $10,000 right now after an 11% drop is worth $8,900. And so if you're buying treasury bonds paying 4%, that's $400 a year on your $10,000. The IRS is going to take $100 of that right off the top of your $400 profit. But when you look at the debasement of the currency, you're negative between taxes, where if you're buying bonds and it's like the government is taxing you for lending them money, which is really stupid. But between the monetary dilution of money supply growing at between 7 and 10% annually, the dollar down 11% now, the taxes on top of all of this. It's a losing game. It's no wonder that they don't say this. So, you know, your $10,000 just lost $700 or $800 or $900 in real purchasing power, if not a lot more, actually more like $1,200 or $1,300 in less than a year. And that's the kind of thing that I think is really, this is what owning precious metals is all about.
If I can just piggyback on what you were just saying, this whole reveal of, oh, look, it's now Morgan Stanley says, you know, it's worth putting in gold, and now a BOA says it's worth it, and all. And it's like, oh, where were you guys 3 years, 4 years, 5 years ago when the central banks of the world were accumulating more gold, physical gold, over in the last 4 or 5 years than the previous 60 years combined? So the little man rule comes pounding to my mind, is like that the big money waits until they've got themselves positioned quietly and then go, okay, now don't say we didn't tell you so, as they are, you know, completely having gotten all the chairs in the game of musical chairs.
Yeah, it's true. And it's only going to get more interesting. You know, you bring in all of these stable coins. And I want to focus on a company like Tether, because Tether right now is the biggest stablecoin company in the world, and USDT. They're the ones that will make they're one of the groups that will make the digital dollars and back them supposedly with real assets, if that's what you call U.S. treasuries. There's almost 200 billion of them floating around the world right now. I think the last I looked, it was 170, 180 billion dollars. But where it gets really interesting is Tether just announced that they're launching a special U.S. dollar-backed coin, and they're calling it USA. And this will be the new digital dollar that will follow the rules written by the Genius Act, which is anything but genius. It's diabolically genius. It's very interesting to me that the CEO of Tether is a guy named Bo Hines, and until August, he was Trump's crypto advisor. He was writing these same laws, and 1 month later, he's profiting from them. It's kind of interesting. But these rules say that every USA stablecoin that Tether issues must be backed by U.S. treasuries. It's a way to create synthetic demand for a asset that no longer has really the organic demand that they used to. But the interesting part is that, you know, we're now being forced into we will be very soon, not just from the banks, but the credit card companies and all of these institutions will start using stable coins to move money back and forth. And they'll all be backed by treasury bills. But what do you think Tether is doing with their own money? They're buying gold. They have $8.7 billion worth of gold sitting in Swiss vaults, and they're now buying gold mining companies. They were just at the Beaver Creek Gold Mining Summit. They made $13 million in profit last year. That profit is issued by the difference between the stable coins the treasuries they're purchasing back in the stable coins and the interest that they get to keep. So they don't apply that interest to the stablecoin holders. They get to keep it. And with that profit, they're converting to hard assets as fast as they can. And so, you know, whether it be BlackRock, who manages 10 trillion, and Gunlock, whose reputation has been built on bonds, whether it be, you know, as the only game in town, whether it be them now talking about buying gold, or Bank of America, or you know, or Jefferies, or Goldman Sachs, or all of these people institutions talking about buying gold, or Tether. I guess central banks are hoarding it. Tether is hoarding it. And when everyone who knows the game is buying the same thing, maybe we should all wake up. I mean, that's what I've been screaming forever. It was just the central banks. Now you got the Western commercial banks talking about it. You got the bond people talking about it. You have this 60-40 mantra that has been ingrained in Wall Street lore forever. You have Morgan Stanley, chief investment officer. All of these people saying it. At what point do people start to actually believe? And that's the question that I guess ultimately will be answered. But again, when you start to see these people betting against their own game, what do you expect to happen? I guess I don't know. I guess we'll see what happens. But if it were me, I would think about that very, very seriously.
Yeah, before we leave this, your point is interesting in that the accumulation of physical gold in the vault by some of these big players, and we've seen that at the sovereign level, where repatriation of gold, onshoring it. You mentioned about the network of gold vaults being built by the BRICS, by China. Those seem, being able to have their warehouse their gold within their own borders, et cetera. And now you're talking about these big commercial bullion banks and so on recommending ownership of gold. And yet most people in the public have no idea how to even purchase gold. It's like a foreign language. For like 3 generations almost, we've been dumbed out of this by taking a substitute of a substitute of a substitute for real gold. Now stablecoins, for people to think that this is something that the public should be required to use if they're going to be able to transact in this. And you mentioned the diabolical nature of that in the Genius Act, I think is not lost on our audience here on Liberty and Finance. Wanting your freedom includes wanting the right to your own privacy and live your own life and to do what you choose with the fruits of your labor. Save it for yourself or your children or for a need or for an opportunity. But it seems that the plans are being laid and the tracks are being laid for the ordinary person to participate in these derivatives of things, where the owners, the originators of those systems themselves are making sure that they've got solid assets locked away. And you've told us for years, don't do what they say, watch their actions, not their words, and do what they do. So it seems that the lesson is not lost on those who are paying attention, is to take care of business for their individual family, for their small organization, their community, and everything by going for solid assets in the hand or in a private vault storage, and not relying solely on ETFs like GLD and SLV or any other new incarnations of derivative electronic versions, synthetic versions of so-called ownership, because as David Rogers Webb tells us in the book, The Great Taking, anything that you think you own, either in the bank or the brokerage or through any of these other methods, has already been, the legal framework is already set up there to where you're not actually the legal owner of private property, that you have the right to hold, to use as you choose, that capital controls can be imposed on you, that restrictions on transactions, social credit scores, all these kind of things. I just wanted to blow the warning horn really loudly because otherwise good, well-intended moms and pops are going to, well, I guess that's the direction things are heading. We want to do what we're being told to do, or do what's on the up and up. And you can just see the train coming before it even gets there, of what it's going to be like to be subject to and subservient to if all you own is these derivative forms. You don't really own them anyway if you're just a beneficial party or whatever they're going to call it now.
Yeah, well, and you're right. And, you would think by now people would wake up to this, especially since gold prices are up 43% this year to date. This is putting them on track for the best annual performance in 46 years. You would think that people would start to wake up to this. Unfortunately, they're always late to the party, i.e. the little man rule. It's the big money who is there right now, and it's the big money that is moving in this direction. I want to talk a little bit about, I try and touch upon the BRICS a little bit each time. Sometimes it's hard because sometimes the information's hard to find, or it just isn't really earth-shattering. This is one of these deals that really isn't earth-shattering, but I think people should pay attention to what they're doing. So, I think that the U.S. is foolish in the way that they have stood up against the BRICS countries with tariffs. And soybeans, China used to be the biggest purchaser of soybeans from U.S. farmers. And you look at the Chinese import numbers for soybeans in August, they were at historically high levels, like the most ever. But the majority of these purchases are now coming from Brazil and other South American growers. And over 12 million tons of soybeans came into China in August. It's the second highest monthly total ever. And almost all of it, 11 million tons or more, about 85 to 90% of all of the soybeans came from Brazil. And now China has logged 4 consecutive months of record soybean imports. And this is, again, I think it's because of supply uncertainty with the United States, because of the trade war. Okay, well, so what, people would say. Well, this is, to me, a very big so what, not only for the American farmer, but also for the American government. Most of these global soybean trades were invoiced in U.S. dollars. And now they're not. And so payments would have to clear through U.S. dollars through the international intermediary banks via the New York clearinghouses. This gave the dollar its dominance. This is what I've been talking about, in our conversation today with Rick and Alistair earlier, talking about chipping away at dollar dominance through settling trade, whether it be the BRICS settling trade on government-to-government level like this, which I'm going to touch on in 1 second, or the BRICS Pay Network, which will allow business-to-business, retail, business to the retail market also to transact outside the dollar. Every one of these transactions is like an axe against like one of the giant redwood trees. Or the Shawshank Redemption, where Andy Dufresne used a little spoon or whatever to chip away at the wall over time. Chipping away at this new system, which isn't using dollars to settling over whether it be BRICS Pay Network, whether it be over the BRICS Bridge Network, or they have something called a direct yuan clearing arrangement that they made in Brazil. Chinese did, and it allows the exporters, including the big soybean exporters, to invoice China directly in renminbi across the renminbi cross-border payment system, which settles in 7 seconds outside of SWIFT. And so this cuts out the U.S. dollar out of the loop completely. So the Chinese importers pay in yuan, and the Brazilian sellers can either hold the yuan or convert them into gold or real if they want. But converting them into gold, and soon in all of these countries, whether it be the BRICS countries or the Belt Road, they'll have Shanghai vaults where metal is stored in all of these jurisdictions, all these multi-jurisdictions. And so you have the system that is being built little by little to cut out the dollar completely, not only in settlement, but also in reserve status. Instead of putting excess into treasuries, they will simply put them into gold, because gold is backing this whole system. These are the things that a lot of the people who do not talk about, who push back against the BRICS and say that they are not as legitimate as perhaps we would think they are. And to me, that is a very silly mistake to make. And you can look at just the info coming out of the Bureau of Labor Statistics, and the BLS, take the L out and they're just the BS. That's all they really are. But even using their own BS, the dollar is worth 82 cents of what it was worth in 2020. That's a 22% decline in the value of our money in 5 years, and it's probably worth a whole lot less. And, so I think when you talk about why these countries are doing it, not only is it the loss of value in the dollar, not only is it the weaponizing of the treasury market, but it is also the silliness of the imposing of these sanctions or these tariffs that are making all of these countries say, screw it. And then you look at, gold futures are past $3,800. And again, you're talking gold and silver moving up, gold's up almost 9% in September alone. And silver's up, 9 or 10% this month alone, up over 50% year to date. So you can see why all of these countries are accumulating gold and silver. You can see why the United States is. I'd like to shift gears a little bit. If you have nothing to say there, I can move on.
Well, I was just trying to come up with a wisecrack about what we used to call the petrodollar. Is it now the tofu dollar or something? But actually, it's not the dollar. It's the tofu yuan. Go ahead.
It is. Well, and the yuan that's immediately convertible.
That's right.
Into gold. So we've talked a lot about silver and how the open interest in silver had declined from 184,000 contracts in June to 154,000 in September. This means that there was covering in contracts. That means that the open interest was declining. Yet the price continued to rise above $40 in the face of a declining open interest. Declining open interest, meaning less people involved or speculating, and rising price, in theory, only happens in a bear squeeze, where the shorts are covering because they're afraid. And now I would argue it's rising because the long speculators realize that metals are in a bull market. And you got to wonder what the shorts are thinking right now as it continues to move higher. But you see all of the silver coming in, almost 11,000 tons of silver have come in this year. About 60% of global mine supply for 9 months have come into the United States. And so basically what you're seeing is, I think, a reawakening again of what silver has to offer. Now, if being on the short side of this has to be terrifying, as we're seeing now massive investment interest in there. Maybe this is why we're seeing such a huge short position in SLV. They're running out of ways to hold the price down. And in the face of rising short positions, silver and gold are still doing well. Of course, they're doing it in SLV and GLD, a little bit more opaque, instead of putting it right on the COMEX. But even still, you're beginning to see big money start to challenge the suppression of gold and silver. And I don't know, I think that it's not just gold and silver, it's platinum, which is up almost 65% this year. And so, yeah, you're seeing, again, what's China doing with platinum? They're importing platinum at a run rate of 58% of global mine supply. Again, it's not just gold and silver, it's everything. Precious metals, base metals, commodities like soybeans. They're doing everything they can, and they're paying for it and doing it in ways that are pushing back against the dollar. But to my point about the short positions, the short position in SLV exploded 67% higher, and gold almost 70% higher. This is aimed at keeping metals down. Now, normally such a barrage of these shorts would crush the price. It's textbook suppression. Flood the market with borrowed shares, push the chart flat, kill the momentum, kill the rising price. But the effort, this enormous effort to hold it down, is pale in comparison to the demand, which is even stronger. And I think that's very, very scary to these shorts. If gold and silver are holding this strong under record short pressure on SLV and GLD, what happens when that pressure fails? And I think it is failing right now. So yeah, I would expect to see much higher prices in gold and silver moving forward. I really do. And I don't know. I think it's just the beginning, Dunagun.
Yeah, I want to make two analogies there and get your insight on the retail investment supply chain, because I had a number of clients. You mentioned that there's been a sudden surge in buying in the past month. We've seen that too. It was a very quiet year up until the last month. And suddenly it's like all heck broke loose, and the phones are ringing, and it's larger purchases in many cases. One thing I'm going to point out is just when you mentioned, what do you see when you see declining open interest in the face of rising prices? Sounds like a short squeeze. We had a number of diligent, long-term retail investors who were waiting for a pullback. Silver had dabbled around 31 for quite some time, and it crept up to 34, and some people wanted to make a significant move, convinced that it was going to be moving upward farther, telling us, waiting for a pullback to 31 range before we pull the trigger. Another week went by, it would go up. Another week went by, it'd go up. Finally, about 36, 37, they pulled the trigger, just giving up on it. So even on the retail side, you're seeing people who've been watching this market for a long time, diligently stacking, buying on dips, going, I better get it while I can. In the face of that, physical availability has been difficult, especially for platinum, but for some other products as well. And premiums are on the increase as well. Can you touch on the retail bullion phenomenon that you're seeing both in terms of demand, supply, physical availability, and premiums?
Yeah, demand is really strong right now. Supply, which has been really good for a while, is getting very tough. And why is that? It's because supply was so good that the dealers didn't re-up. And with the rising prices, the cost of carrying this stuff is very expensive. The cost of shipping it has become very expensive. The cost of insurance to ship it has become very expensive. Just the cost of holding a large inventory has become very expensive. You better have millions and millions and millions of dollars in order to run an inventory, or you have nothing. And so, I look at our inventory, which I'm not happy with it right now. It's gotten so low so fast. And this is one of the things I was concerned about. And I say this on your show all the time. Just like that, it changes. And the market does change. And it wasn't just the companies like ours that feel this. It goes all the way up to the primary distributors who, again, they were choking on product too for a while. Like you said, that was slow at the beginning of the year. And just like that, it's not. And there's lag time between getting new product in from around the globe. The U.S. Mint, who really is the model of inefficiency, can never keep up adequately. And this is with now just a glimmer of new demand. And maybe it's coming from higher levels because you're getting this advice coming from Morgan Stanley and Jefferies and, Bank of America. These people are talking, the CIOs or Michael Hartnett's of the world aren't talking to Jane and Joe Sixpack. They're talking to their institutional clients, their big money clients who are paying huge money for Michael Hartnett's writings. And same thing with the chief investment officer of Morgan Stanley. That's not stuff for the public. You pay for that stuff. This is the stuff that's given to their big clients. These are the people who are making moves before the public. The little man is still sitting in the Mag 7. The little man is still sitting in traditional assets that are not really doing or set up to do as well if things continue as the insiders are selling and the public is all in. It's something that concerns me, honestly. And you've had me on your show here now talking about this really since 2024, where it's been slower than we would expect in an environment that shouldn't really, if you look at the facts, it shouldn't have been slow. But now people are waking up, not just the diehards that you and I have spoken to forever, the mainstream, just a little sliver of it, and probably the sophisticated side, the well-informed side, more so than the masses. But when you get, Dunlock and Bank of America and Morgan Stanley and Jefferies all saying the same thing, that's going to change. And now all of a sudden supply is becoming tougher to come by. Premiums are rising, and it doesn't take a whole lot of demand to wipe out inventories that have not really been aggressively added to. So we are in the process of doing that right now, but there is a lag time. And I would say to you, you haven't seen anything yet in terms of demand. If these guys are right and they're telling, putting the seed out there that hey, this is about to explode, just a small uptick from the public will decimate availability in this industry overnight. And I don't say that lightly. I mean it sincerely. There's so much money out there, not to mention M2 spiking right now, money creation and just money in circulation that's been sitting on the sidelines in places like money markets and in treasuries, which are now being, maybe you shouldn't own so many, reevaluated by the people who sell them. Yeah, I think that ultimately, I've said it before, I'll say it again. I'm not talking my book. I'm not trying to get you to run to the phone and make a phone call, but I'm dead serious. I really do believe that this market, before it's all said and done, will be looked at two ways by the people from the outside. Geez, prices got so high, I'm out. And the people on the inside, I want more, but it's so hard to get it. And the prices, the premiums are high and the delays are high, and used to be so easy to get it. I took that for granted, and now it's next to impossible. I believe that'll happen. I do. Because on our interview with Rick again this morning, he talked about the 0.5% allocation. What if it's 5%? Well, these guys are saying 20 and 25%. If it went to 25% or even 20%, well, that's a 40-fold increase, just like that. Do you think that this industry can survive a 40-fold increase? Not a chance in Hades. And it would be lucky to survive 24 hours with a shift to that magnitude. And if they're saying 20 or 25, what do they really mean?
That's exactly where I wanted to go, because back in the booming stock market around the year 2000, there was a clear set of things that always were talked about. One is there were the whisper numbers before earnings were released. So, Dell or Amazon or whoever would say that everybody's expecting, well, they say they're going to do like 25 cents or whatever it would be, but we're all thinking it's going to be much greater. And if they didn't blow out that big whisper number, then the stock would sell off temporarily, because there was always this other reality you weren't being told about that the people who really knew what was going on knew about. But the same thing was on the analyst recommendations. When they took a company from a strong buy to a hold, that was a sell. I mean, that was absolutely how everybody interpreted that. They put in a little magic decoder ring. Oh no, it's a hold. That means it's a sell. Here's the same thing. Suddenly they go from, as you've been saying for week after week after week after month on our show, in the face of persistent strength in gold and silver, and in the face of destruction of the dollar, just absolute silence from the mainstream financial press. Nobody could talk about gold. Well, by the time they start saying, well, you might now to the retail, people who are listening to the evening news, if they start to tell you might want to dip your toe in the water, they've been up to their neck in it up till now, and that's silent language to those who know how to listen, to say, look, you better get it now or you're not going to get it.
Well, and it's not even the mainstream talking about it yet. These are the top analysts at commercial banks who are not speaking to the public. They're speaking to their institutional clients first. Again, the big money. So the big money, the central banks and the commercial banks, well, they've already got their seat at the party. Now they're saying to their big money who they want to take with them on the ride, reallocate. But the people down here, they don't hear any of that yet. When they're told to reallocate, you might want to start to think about what happens next, because the big money will have been in position long ago. And that's when all the profits are made. And, again, we don't buy this stuff to get wealthy. We buy it because it is wealth. And the biggest money in the world is signaling that right here in front of us.
And the flip side of this is going on in the real estate market. I've mentioned this multiple times on our show, that the 55 plus community that we moved into here in Florida, in the fastest growing county in the state, in the country, the fastest growing county in the country, had 4 houses for sale when we moved into it. Now there's 40 houses for sale. And according to Michael Pinto and others whom we speak to about this, Alex Newman and others, a lot of the residential real estate in our country is now owned by investment firms like BlackRock, like it was Zillow and others. And once they get the whiff of this is not going to be the place for them to be, they can put just thousands and thousands and thousands of homes on the market instantaneously. They're not tied to them like mom and pops are. So if mom and pops and the baby boomer generation has been watching their tax burden on their home valuation go up and up and up, they're thinking, okay, this is biggest single part of my net worth is my home equity, my valuation of my home. And these experts are telling us, if you're not one of the early ones out, if you're not one of the early ones to sell, don't even think you're going to get, you may not even, we have people in our neighborhood who are not only getting not sales, they're not even getting showings. because it's such a difficult market.
Well, yeah, the only cure for the slow real estate market is lower prices or higher interest rates, not lower interest rates, because lower interest rates, again, is what got us into this problem and created distortions in asset prices. This is where the mistakes are being made. If interest rates were fairly set, cost of money would be sufficient enough where asset prices would come down. And that's the thing. By pushing the Federal Reserve into lowering rates, I fear we'll see the same thing that we've seen in Canada and in England, where they push the front end of the yield curve down and the back end says, no, thank you, and goes the other way. Because they're like, well, you're never going to get your balance sheet in order. So, if we're only going to accept this low rate for an extended period of time when inflation and money creation is eating away, completely rendering a negative real return, I'll pass. And I think that's what you're seeing. So, yeah, you're right. If you're not out early, you're probably dead in the water. And that's why you have no showings, and because it's just unrealistic. And I think people are concerned about the real estate market. During the pandemic, people wanted to get to somewhere they wanted to be to in Florida and in Texas, these states that were pushing back against the conventional popular rhetoric surrounding the pandemic. And now it's cooled off a bit. And I think anyone who would be paying, these high prices is going to think twice about it, especially with higher interest rates. People don't have the ability, higher rates in the mortgage market. They don't have the ability to take out debt the way they did a few years ago at 3%, and double the cost of money if they're not paying with cash. Yeah, you not only have people who would be nervous if this is sustaining, but also just have too hard of a time either getting qualified or being able to afford it. The real estate market is a scary one for sure. And you put those big institutions like BlackRock and Blackstone, put their feet to the fire and they get nervous and start dumping, thousands and thousands and thousands of homes. We will see the real estate crisis of 2008 look like a party compared to what it will be this time around with all of that investment in the market.
And for those of you who missed our interview with Mitch Wexler, who did talk to us about these inflated valuations that were driving inflated tax revenues to every school district in every state in the country and in Canada, by the way. When that happens, what you just described is a correction, a reality check on the valuation, on the actual market value of homes, whereas people are paying taxes. They become a real albatross around the neck of the baby boomers, and their estimates are coming up to 33 to 36% of people could lose their homes because of these ridiculous tax valuations that they've been saddled with over the period of time, and counting that as their largest asset, but they have no control over how much is the market's actually going to bear, what the real clearing price is in the coming real estate crash. So,
well, there's one other thing too about living in Florida and especially places with large HOAs, as just about every place in Florida is an HOA and a gated community, so to speak. But in the summer, I'm an avid golfer, and in the summer down here, you have reciprocity with about 15 of the other our country club, with 15 of the other country clubs in the Palm Beach area. And one in particular that I'm thinking of, the place is called Hunter's Run. It's a beautiful facility, 3 very nice golf courses, a huge, clubhouse and all. I mean, massive place. But unlike our country club that it just has homes, this place has homes and townhomes. So they have 3 or 4 times as many people living there as in my country club. But what's very interesting is that these townhomes, there are many of them that are being sold for $5,000. $5,000. Now, these places are probably, the tax is probably valuing it at $400,000, because what's happening is that mom and dad pass away, kids living up somewhere else, not in Florida, they inherit this, and it's their responsibility to maintain the HOA payments and the country club dues that they now own. And the only way out of it is to sell the place. You can't just back out of it or they'll sue you in essence. So they're offering the house at next to nothing. $5,000 and the house is yours because they don't want to pay not only the $20,000 a year country club dues, but the HOA fees and whatnot, the assessments that come along, the property tax. And this is something that people really don't think about is that, you've got taxes at all-time highs on these properties. You got HOA fees that you need to pay. And if those people living in a place like a country club, you got that to deal with too. So speaking of Florida, before this is all said and done, you may see places like Florida really take it on the chin and start to reprice what these neighborhoods are really worth. And that in and of itself creates a problem because as the prices and everything has moved up, so too have the dues and the entry fees into these country clubs as well. When I joined my country club compared to where it is today, in 4.5 years, the cost to join my country club is almost up 200%. It's up 175%. So initiation has gone higher, monthly dues have gone higher, HOA numbers have gone higher, and this is all based upon rising property values, which, seem to me to really not be realistic right now. So interesting times ahead, and the moral of the story is maybe real estate isn't that asset we always thought it was going to be, and that is a function of suppression of interest rates. When you mess with Mother Nature, this is what you have to deal with.
I realized I've been enjoying the conversation. We're running out of time, and we wanted to get you a chance to let us know about the weekly specials before we sign off. It looks like we have three so far. The 90% silver US half dollars assorted dealer's choice at 69 cents over spot. Amazing.
It's as good as it gets done again. It truly is. We were selling those at 12, 13, 14 over spot from 2020 through 2024. From a standpoint of value, there is nothing better in silver. Nothing. A dollar's worth of half dollars. So $2 half dollars is 0.715 ounces of pure silver. So, $1,000 face value or 2,000 of those half dollars is 715 ounces of pure silver. There is nothing better. There is no better value. You can't even pay that. You're not even going to get that low of a rate on 1,000-ounce bars right now. So yeah, it's as good as it gets.
Also, 1 ounce silver coins, the Australian Year of the Snake 2025 coins, $5.99 over spot.
Yeah, those are a little bit more of a special coin. Those are limited edition. They are the Lunar Series from the Australian Mint. Not as good of a value for building your portfolio, but for those people that like something a little bit different, that does offer a little bit of enhanced potential, yeah, certainly I do like them. But let me just be very clear. If I'm building a hot fudge sundae and I need a bowl of vanilla ice cream, that's the pre-65 half dollars. If I want something like some sprinkles on top, that's going to give me a better return, perhaps something that does have collector appeal, something that isn't made in massive quantities, that would be at the top of the list, the Lunar Year coins.
We also have the 1 ounce gold Austrian Philharmonic, random years at $75 over spot.
Yeah, and again, this is one of the 6 major mints, nothing exciting. You have the U.S., Canada, Australia, United Kingdom, and South Africa. Those are the main 6 mints of the world, and just another really good, inexpensive way to own 1 ounce gold coin. That has nothing political on it, no queen, no historic symbol. It's just instruments that you would see in the Vienna Philharmonic Orchestra on one side and the big organ at the music hall in Vienna on the other side. They're beautiful, lovely coins.
Andy, thank you for those specials. And folks, we also have plenty of other inventory at the moment, less than we did a week ago, especially in platinum. Oh my gosh. But don't hesitate to reach out to us at 888-81-LIBERTY. You'll see that number on the bottom of your screen. And we want you to let us have a chance to make sure you find the right thing while we still have it. And Andy, as always, thanks for being our advance guard, keeping our eyes looking forward, in the forward indicators that you follow and the forward insights into the supply chain that affects all of the moms and pops that watch our show. And thank you, everyone, for being here. Andy, they're here because of you. So thanks, everyone.
Well, I appreciate that very much to everyone out there and to you, Dunagun, for letting me be a part of it and for being a part of your team. And it's been one of the best experiences of my career, and I look forward to many more years of it together, and starting with next week. So until then, I hope you stay well.
Take care, everyone.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 29th through October 6th, 2025, while supplies last. First this week, 1 ounce gold Philharmonics are just $75 over spot. Next, 90% silver US half dollars are just 69 cents over spot per ounce. And finally, the silver Australian Year of the Snake coin for 2025 is just $5.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.